Investors breathe a sigh of relief as Ben Bernanke promises that the Fed will do all that it can to keep our economic recovery moving along. Stocks rallying over 1.5% across the board on these reassuring words and a better than expected GDP revision. So how did top economists rate the Bernanke speech today? CNBC's Steve Leisman has the view from Jackson Hole, Wyoming.
Thanks, Trish, and good evening from Jackson Hole, Wyoming, where Fed Chairman Ben Bernanke gave a much-anticipated speech where he said very definitively the Federal Reserve stands ready to step in and use additional easing measures to sustain the economic recovery. He countered some of the talk that's been out there in the market that the Fed doesn't have any tools. He said the Fed has the tools, and those tools would be effective at lowering interest rates if needed. It's the if needed that was the key to the speech. The Federal Reserve Chairman acknowledged the weakness in the economy and in the jobs and the housing markets, but he said the 2011 forecast from the Fed, which is pretty robust, he stood behind that. Here are the keys to Fed Chairman Ben Bernanke's speech today. He said they would evaluate more easing, they would weigh the costs and benefits of each of the options, and strongly resist deflation. Those are some of the strongest words from him on that topic. And as the deflation risks increase, so do the benefits of fighting deflation, and those costs diminish. Among the three options he said are possible, the Fed could purchase long-term securities, it could modify the language to make the extended period commitment more definitive, and it could reduce interest rates on excess reserves, increasing the motivation perhaps of banks to lend. We talked today with St. Louis Fed President Jim Bullard, and he echoed Ben Bernanke's outlook on the economy.
I don't think a double dip is very likely at this point. I think the outlook has been downgraded, but it's still positive, and that's where we are. Of course, it makes everyone nervous, of course, but it's a little bit weaker. I still think we'll get reasonable growth in the second half, and importantly, I think growth will pick up in 2011, and we'll be back on track.
We also did an exclusive interview with Bundesbank President Axel Weber, and he gave a slightly different outlook from Europe and especially from Germany, where he says the economy is more robust than the United States.
There's not much concern for recession, a renewed recession, but performance will be somewhat weaker going forward. Fourth quarter, third quarter, we're going to see lower numbers than that, but still growth is going to remain there, recovery is on track.
Overall, the economic outlook in the hallways that I'm hearing from the leading economists and central bankers is a little more optimistic from what I've heard from Wall Street. The key here is they expect the economic recovery to continue, do not see a double dip, and believe that hiring will even pick up pace later this year and into next year. Back to you, Trish, from Jackson Hole.
Okay, Steve Leisman, thank you for that. So did Ben Bernanke get the job done, and does he really have any more monetary policy options to help our ailing economy? Here now is former Atlanta Fed president and Middle Tennessee University professor Bill Ford, also Peter Schiff, president of Euro-Pacific Capital Incorporated. Peter, I'm going to begin with you. Did Mr. Bernanke satisfy you in any way? Do you feel like we are any closer to good economic times?
No, he's done enough damage. I wish he would stop and leave the economy alone and let it heal. You know, deflation is not a problem. It's healthy. It's what the economy needs. You know, the Fed inflated an asset bubble, let it deflate. It's the stimulus that we don't need. It's toxic. It's the reason that the Fed is turning this recession into a depression.
Yeah, but Bill Ford, I'll let you retaliate on that one. I mean, if the Fed were just to say, okay, we'll just let the market completely go at its own, do we run the risk that we could see a much more severe scenario?
I don't think we're headed for a double dip either. But if you read Bernanke's speech very carefully and listen to, for example, what former Fed Vice Chairman Alan Blinder said in the Wall Street Journal the other day, and all of us who really watch the Fed carefully, the Fed really is out of ammunition in terms of big changes that it can make in spite of what Bernanke said. I mean, lowering interest rates when you're already below 0.25% is
not going to satisfy you, right?
It's not going to work, and just buying more and more securities to drive down long-term rates isn't going to do much, and telling everybody you're going to keep rates low, everybody already knows that, so I think the market is overreacting and making it sound like good news. It's really not good news. It's the fiscal policy side.
But, Peter, you don't want the Fed to do anything, so in a way you're kind of happy they're out of bullets, right?
Well, they shouldn't have fired him in the first place. I mean, the problem is rates are too low. They need to be higher. You know, we don't have any savings in this country, and we're not going to get savings with 0% interest rates. And the problem is the government is spending much too much money. It's borrowing much too much money. We're never going to restructure the economy to produce things, to provide employment for our citizens, unless the government gets out of the way, unless the government shrinks and returns resources to the productive part of our economy.
And we don't necessarily see that happening in the near future, Peter Schiff. So what does that mean for the next year ahead?
Look, it means that more people are going to lose their jobs, and unfortunately, when they go to spend their unemployment checks, it's going to, they're going to see higher food prices, higher energy prices, higher health care prices, higher clothing prices, higher insurance costs, they're going to see a falling standard of living. This economy is never going to recover until we understand that the source of the problem is government stimulus, it's cheap money, it's excess regulation, it's excess government spending.
Out of control.
Yeah.
Hey, Bill Ford, is Peter right?
I agree with a lot of what Peter just said. The dumbest thing they could do would be to increase taxes, which seems to be Mr. Geithner's hobby horse, to increase taxes on the people who do more consumer spending than anybody else, and on small businesses who are the ones that have to do the hiring. That would be a really dumb fiscal policy move, which unfortunately...
But it's not
well,
just,
I hope they hear you. Hey, guys, hold on for a second, because Marty Feldstein might agree with some of that. Harvard economist Feldstein. Take a listen to what he had to say.
It's bad, and it's getting worse. These housing numbers were much worse, I think, than people expected. With the end of the subsidy, the tax subsidy, housing is in terrible shape, and I think that's going to mean lower house prices, and that's going to be a drag on consumer spending more generally.
Yeah, and the consumer, we all know, makes up better than 2/3 of this overall economy. Consumers don't have jobs, Peter Schiff, so how are they ever going to start spending again?
Well, the thing is, and when they get jobs, we need them to start saving. We don't want consumers to keep spending. That's part of the problem. They bought stuff they couldn't afford. They borrowed the money to do it. We need a real economy. We need savings. We need to grow the economy by producing stuff. We need to export more to people who have savings, who can afford to buy things. And, it's not just these higher taxes. And, of course, we're trying to tax the people who are going to save money and who are going to invest. But it's the cost of complying. All these new rules and regulations are strangling American business. To the extent that Americans are going to expand their businesses at all, they're going to do it overseas where they don't have to confront this regulatory monster.
Yeah, so, Bill, what would be your prescription here? Would it be a tax cut right across the board for businesses, for consumers, payroll tax cut?
Absolutely. We have one of the highest combined tax rates on businesses in the world. That's hurting investment. Peter's right. We need to not try to stimulate consumption spending above the 70% of GDP. 20 years ago, it was closer to 60%. We need not more consumer spending. We need more investment spending to help us become more competitive on export.
Okay, so why raise that capital gains tax? Why raise the tax on dividends? Why treat dividends as income? I mean, what's going on here with the policy, Bill Ford, that we're seeing coming out of Washington?
It's crazy policy. It's attempting to re-implement what never worked under President Roosevelt, when during the entire time from 1933 until World War II started, we had unemployment in the 15 to 20% range in spite of government spending. We do not need bigger government. We need more business investment, and that will make us more
and Peter Schiff, a lot of people are starting to feel this way. You go out to Middle America right now, and there's a momentum, a growing momentum of people that are very frustrated with the amount of money that big government is spending and the fact that they're getting taxed to death in the process, are they not?
Yeah, well, I know that. I ran for Senate for a while here in Connecticut. I didn't win the Republican nomination, but I talked to a lot of people who are frustrated by the amount of money that the government is spending, and they understand that the spending is the true cost of government. It's not what it taxes, it's what it spends. And if we're going to really stimulate the economy, government has to slash spending, because the resources that the government is spending, those are the resources that private sector can't invest. We can't grow the economy if we're growing the government. The only way to grow the economy is to shrink the government. But we are doing the exact opposite of that right now.
Indeed, we are. Okay. Gentlemen, thank you so much. Have a terrific weekend. Thanks to Bill Ford and Peter Schiff.